Results from the latest Ernst Young BER Retail survey reveal that the growth in retail sales volumes slowed notably during the second quarter of 2012. Joining us now for a look at this data, we have Derek Engelbrecht, who is Retail and Consumer Products Sector Leader at Ernst Young. Hi, Derek.
Hello.
Well, it's convenient for you to come in because yesterday we had the official retail numbers out at 1 o'clock on the show, and a disappointing increase of 1% for April, year on year for April. Where does your survey fit into that kind of data?
So the survey conducted by the BER is done in the month of May, but effectively covers the second quarter of 2012. And the message is largely in line. Stats SA number was below that of many of the economists and analysts. And so does the survey confirm that business confidence index fell from an index level of 61, where the majority of people were confident and happy with prevailing business conditions, to an index level of 39, which means that the majority of people do not have confidence in prevailing business conditions.
And that's a big drop.
It is a significant drop, and what's also notable is that the retail sales volume growth for all three sectors, the semi-durable, non-durable and durable, are all down on the relative comparative.
Well, let's look at some of those sectors, and as always with these things, the overall number is, I suppose, an average, and it's a combined thing, but what are the sectors that are interesting you most?
In general terms, the semi-durables were the better of the bunch, so to speak.
What are semi-durables?
Semi-durables includes footwear, apparel, clothing. They were doing better in relative terms, but the non-durable sector continues to be under pressure for a variety of reasons, but generally speaking, all around the affordability and the shrinking of the discretionary income pool that's driving consumer behavior at that spectrum.
What about the food sector? Because you would expect, that's the one place you have to buy. You don't have to buy a new lounge suite, or shoes even, but you have to buy food.
I think for a long period of time, the educated consumer ends up making choices where they trade up and down the value spectrum. I think we've got to the point where most consumers are buying differently. Certainly looking at dealer-owned brands in a different light than before. Those would be the private labels sold by the big retailers. But I think at this particular point in time, people are being forced to make decisions where sometimes buying food or certain kinds of food are effectively competing with buying airtime, for example. And that's a very non-traditional way of competition.
The retailers have come out with very good results. So what's happening there? I mean, you think of Spar, you think of Shoprite, Checkers, Woolworths, Pick n Pay. Those are probably the four big ones. And A, they are widely held by foreign investors, which have driven the prices up. B, they're very competitive with each other and in many ways are world-class in their systems and their approach. And in the recent results season, they've all done well. So how does that square against the 1% increase and what you're saying now?
I think the 1% increase in volumes probably tells the story. I think the increase at a turnover line is always a curious mix of what you've sold, how many you've sold, and at what price you've sold. So it's very, one needs to understand the breakdown of that very, very clearly. By and large, those retailers that have taken strategic decisions to compete in the affordability space, in the value for money space, are the retailers that continue to show great results. But I think when one looks at the bottom part of the income statement, it's very clear that they have to work much harder in the current climate to deserve the kind of turnover levels that they are maintaining.
What about at the higher levels? And probably the exception to what I said a moment ago is Pick n Pay, which is still battling to get back to the status and the level of earnings that it had before. But the others have done well. Woolworths, although they say they're not that more expensive, they're perceived as more expensive. How would that fit into your value buying proposition?
Woolworths have been trying very hard to re-educate the consumer. For a long while, they had a proposition that appealed to a certain kind of consumer. That consumer became far more discerning as times became tough. And I think Woolies are having success with re-educating a particular kind of promotions, and effectively, if they can lure the consumer through their door, they continue to be competitive on a basket of goods, which I think is what they've been saying all along.
Also, they have that interesting model. Some of them are just food shops, some of them are clothes as well, which the others don't have that kind of mix, which I suppose can be a strength or a weakness depending on how you do it. But with this subdued growth, you say in your statement, retailers have now started to trim the order volumes that they place with wholesalers and manufacturers. So this is now where we see the effect of a lower growth.
Very much so. So we've had 2 quarters where the sales growth has not been at the kind of levels that analysts, economists and probably retailers would have liked it to be. And I think in some responsible way they're looking forward into the 3rd quarter. Those purchase orders are slowly but surely filling up the supply chain, and they are looking at if there are any light at the end of the tunnel that would make a significant positive impact on on volume growth, probably not seeing what they like, and as a consequence just tempering the way in which they place the orders on the supply chain.
The way you're talking and the way the numbers look, and we listen to what's happening in Europe, which will affect us, are we looking at the next couple of months when those numbers come out, we're not going to see growth at all?
I think the growth figures and sales growth in relative terms will continue to disappoint. We certainly make the point that sales growth will moderate even into the 3rd quarter of the year. And there are a number of reasons. I think there were a number of factors that had a very positive impact on the 3rd quarter in last year. Notably around some employment activity, some significant tax relief that kicked in, as well as what would appear a significant growth in dividend payments during that quarter, as well as property rental income, that I don't think we envisage happening again in the 3rd quarter of this year. So strictly speaking, when one compares those 2 quarters with one another, it's going to be off a challenging base that had the benefit of some of those events.
I'm not sure how much weight in the consumer sector state employees have, but we heard today that talks have been broken off between government and the unions, which is something of a surprise given the track record. Do you expect a lower government wage bill to also depress consumer spending?
I think the government is literally between the devil and the deep blue sea. It cannot be seen to be signing up to numbers that fuel a wage bill and becomes inflationary in a way. But on the other side, they must have another eye on the overall unemployment statistics and be seen to be doing the right thing. So whether it will increase, I think it will, to the extent that the worker would like it to, probably not.